Hello everyone and welcome back to the channel. The poll results are in and most of you requested a stock analysis on Canadian National Railway, ticker symbol CNR on TSX or CNI in US exchanges. So here we go. Many investors see Canadian National as a stable, defensive, wide moat and long-term investment, but the stock's recent performance tells a different story. In fact, over the last 5 years, Canadian National Railway returns were negative. It has significantly underperformed the broader market. You actually were better off putting your money in a saving account than investing into CNR. This underperformance happened while both S&P 500 and S&P TSX Composite Index has delivered solid gains during the last 5 years. This hasn't been a smooth ride either. The stock has been highly volatile, experiencing sharp drops after hitting a high in 2024. When we look at the financial metrics, revenue, for example, was almost flat in the last 3 years. In fact, it only grew around 3% CAGR in the last 10 years, which is a super slow growth. Same story with operating cash flow, and even worse with free cash flow, as free cash flow has been declining in the last 3 years. Even investors who believed in the company moat are starting to think again about the future of this business. For example, Chris Hohn is one of the best super investors in our time, and he's been known for investing in businesses with high barriers to entry, such as those with irreplaceable physical assets or significant scale. He's one of the investors in Canadian National Railway. He owned both Canadian National and Canadian Pacific Railway stocks, and in the last quarter, he actually reduced his Canadian National position by 14%, significantly more than his CP position. And CNI is now only a 4% position in his portfolio. If we look at Canadian Pacific performance in the last 5 years, it is up around 30%. We can again see that Canadian Pacific has outperformed CNR in the last 5 years, even though they were the ones that had a significantly large acquisitions. Let's look at other railway companies. For comparison, we can see Union Pacific, which was up 30% in the last 5 years, and CSX, which is up 57% in the last 5 years. So why the poor performance of Canadian National? Why Canadian National Railway is underperforming both broader market and the other railway stocks at the same time? It's not just one thing. It's a combination of different factors. It's a combination of market headwinds and company-specific issues, particularly management issues. Canadian National Railway has been hit by a slowdown in freight demand, global trade volatility, and a shifting US tariff policies. These external factors have made it difficult for the company to meet its own projections, but these external factors are there for all railway companies out there, so the main issue is coming from inside the company, the management team. The management team has come under fire for what many see as a failure to deliver on promised turnarounds. Over the last 2 years, they have repeatedly issued optimistic earnings growth forecasts, only to cut them later. Recently, CEO of CNR cut the revenue and earnings forecast again due to tariff uncertainties. This is her quote. Based on what we saw in Q2 and what we are hearing from customers, we have reduced our volume outlook to back half of the year and consequently updated our full year volume assumptions to low single digits. Canadian National also lowered its 2025 forecast for adjusted diluted earnings per share growth, saying it now expects growth in the mid to high single digit range. A previous estimate from Canadian National expected adjusted diluted earnings per share was to increase between 10 to 15% for 2025. This inconsistency has raised serious questions about management credibility and their ability to navigate a challenging market. When examining Canadian National Railway and its recent stock underperformance, another critical factor to consider is the company capital allocation strategy. For the last couple of years, Canadian National has consistently increased its dividend and engaged in extensive share buybacks. The concern arises when you look at how these shareholder returns are being funded. While companies can finance dividends and buybacks through strong free cash flow, Canadian national debt has been on a consistent upward trajectory. So Canadian national net debt has increased significantly over the last 5 years from $11 billion to over $20 billion. This has led to a rise in key leverage matrix and placing it on the higher end of its industry peers. The continuous need to service an expanding debt load, combined with the commitment to even higher dividends, can restrict the company financial flexibility. This becomes a problem specifically during economic downturns or when a large unexpected capital expenditure is needed. And that to me is yet another mistake of management team at CNR. The issues aren't just financial. Canadian National has faced significant operational problems, including network congestion that has hindered efficiency. They also have been in high-profile labor disputes, which led to national rail stoppage. These internal conflicts add another layer of uncertainty for investors. Speaking about operation efficiency, this is yet another reason why Canadian Pacific Railway has outperformed Canadian National Railway in the last 5 years. Look at this short clip from Bloomberg when these analysts explain why Canadian Pacific outperformed Canadian National because of their better operation efficiency.
Now, CN Rail stock as of today down about 19% in a year, CP down about 7%. Why has CP tended to hold up better?
Yeah, great question. I think it's really just sort of a combination of two things. One is CP has the benefits of much better traffic growth. You might recall they did a big merger just over a year and a half ago now with KCS. And so that's allowing them or affording them additional traffic growth opportunities that are not afforded to CN at this point. It's really more of a north-south story now where they really connect all the way down into Mexico, and they're adding new services around that. That's helped them a lot. The second part of it is operational and execution, and this is where CP is just continuing to demonstrate that they're really the standout performer, executing superbly almost in any traffic environment. CN has always been a good performer, but they have stumbled a couple of times in the last year and a half.
Adding to the list of issues, there are a series of safety and environmental incidents as well, and Canadian National has been fined millions of dollars for environmental offenses. These events not only carry financial penalties, but also severely impact the company's public image and operational reputation. Despite all of these struggles, the company has also some merits. Canadian National has an extensive rail network and a diversified freight business. However, the recurring pattern of missed forecasts, poor capital allocation, and operational issues combined with external pressures and safety concerns has made it very difficult to stock for investors. Now, we know that the last 5 years were terrible for Canadian National investors. But what about the next 5 years? Well, let's look at my discounted future earnings model and see what will happen in different scenarios with the stock. I put my expected rate of return to be 10%. So now, in the bear case, I considered a bit of profit margin compression, a 4% short-term, 8% mid-term, and a 5% long-term growth, and a terminal multiple of 15. For base case, I went with 6% short-term, 10% mid-term, and 7% growth in the long-term, and terminal multiple of 18, which is equal to the current multiple of the stock. For the bull case or best possible outcome, I went with a bit of margin expansion, 8% short-term growth, 12% mid-term growth, and 9% long-term growth, and a terminal multiple of 21. Now, if I hit calculate, the software will give me some information about the intrinsic value of the stock in different scenarios. So it should be between 95 Canadian dollar and 187 Canadian dollar with a fair value of 138 Canadian dollar. Compared to current share price of 130 Canadian dollar, the stock trades for an almost 6% discount. It is a buy for a 10% return. So it seems Canadian National Railway should be able to perform in line with historical market performance in the next 5 years if they can hit their own growth estimates. But for me personally, I want margin of safety and outperformance against the markets. So I put my expected rate of return to be 12%, and then if I hit calculate again, we can see that the fair value is 114 Canadian dollar for a 12% return, which means the stock is not a buy for me personally. Thank you for watching, and I hope to see you guys in the next video. Farewell.